you've got to come up with a year-long strategy, a little bit of an outlook here of what to expect in 2010, just to give us some ideas and some perspective on how to play this market right now is Binky Chadha. He's the Chief U.S. Equity Strategist at Deutsche Bank, and he's here with me live in studio. So the overplayed adage is, you know, so goes January, so goes the year.
Sure.
Can't make too much of an up market in the first trading day. But what should we be expecting? Can you set sort of the stage for me as to what environment you're expecting here?
Sure. I think that the dynamic that's been at work since the bottom in equities in March, which is basically that financial markets overshot to the downside, the corporate sector, in terms of its spending, overshot to the downside, is still very much at play. And 2010 is going to see, in our view, a considerable repricing that takes that back.
So taking that back, I mean, the traditional leadership position is taken by financials. Mm-hmm. What's your outlook for that space? Do we need financials to participate to see the equity market really return to strength?
Financials is our biggest overweight. We see basically the financials as the sector that is cheapest on normalized earnings. If you think about financials in terms of their relative performance on simpler metrics, you know, the market has risen quite a lot, but it's only at about 60-65% of its previous peak. The financials have risen by even more in percentage terms, but they're around 40% of their peak. So we see much more significant upside in the financials.
So how much of that is an indication, or should I be reading into that as an outlook for where interest rates are going to go?
We think interest rates are going up. We think the Fed will...
In 2010, you think that?
Absolutely. But it's important to keep in mind that historically, once the Fed has begun to raise rates, it has done so on you know, some confidence that an economic recovery is actually going to unfold, and those rate hiking cycles have really not had important implications for the trajectory of equity market recoveries.
Now, you're betting on mergers and acquisitions continuing to gain momentum here. We saw a startup in 2009 to that. If you're going to buy takeout targets, what sectors do you look at right now, or is it really company by company?
It's company by company, and I think it will be across all sectors. You know, in our view, what you want to look for is basically a set of criteria defined by the M&A that we've seen over the last 12 months. And we have a basket that basically capitalizes on the traits that we've seen that acquirers are looking for. And you know, rather than take the very severe idiosyncratic risk on one or two names, we think that you want to play it by a basket, and we have such a basket to recommend to investors.
When you look at what the dollar's doing today, we thought we'd see stronger dollar in 2010. This morning, we're seeing a bit of weakness there, but you're betting that the dollar strength story is going to dominate in 2010. How are you playing that?
So most vulnerable, basically, to a rally in the dollar, in our view, are energy and materials. Energy is our biggest underweight. Not only because of the dollar, but also because the fundamental story looks weak to us.
Is that inverse correlation going to survive there, though?
The correlation between oil prices...
Between dollar and commodities. What's the correlation going to be there? Is there going to continue to be one?
We think that that correlation will remain. It's a correlation that exists for fundamental reasons. So it may not be as strong as it's been because growth matters too. It's not the only two things that matter, but in our view, there is a very good, strong fundamental reason for why the dollar matters for oil and commodity prices, which are priced in dollars. And so that impact is there for a fundamental reason and will remain.
Now, you're long retailers. Explain that to me, because it's hard to find someone these days who's optimistic about the state of employment, even in 2010. So what is this a bet on? Sure.
It's a bet on several things. It's a bet that the employment picture will be better and the labor market picture will be better than what's priced in and what is expected. It is also a bet on a bottoming in the dollar, a rally in the dollar, which should impact oil and commodity prices, free up disposable disposable income for consumption. It's also been our view for a long time that the slowdown in the U.S. consumer has been in the price for a very, very long time now. Retail has outperformed significantly, so we've reduced the extent of the overweight that we have, but we are still overweight retail.
Well, it's said often that retail is one of the first to go down heading into a recession, some of the first to come back. When you look at the exposure to emerging markets or the amount of exposure you want to have to domestic companies right now, how are you weighting that?
We would overweight U.S. equities relative to emerging markets. Emerging markets have had a very strong run. Some would call that a secular run, but it's really been since 2002, 2003, up until now. And there's two important points to keep in mind here. Number one is that pattern of outperformance has coincided strongly with the dollar down cycle, which we believe is reaching at least a bottom.
I thought Asia was going to lead us all out.
I mean, if you look at the PMI numbers that came out this morning, if you look at the new orders components, it's a very neglected fact that actually U.S. new orders in the PMI are outpacing those in China. So even at a fundamental level, I would argue that the U.S. is doing just fine.
We'll watch that.